Ever thought about measuring risk in options trading? It's all about understanding the Greeks. Welcome to the fascinating world of options trading, where the Greeks play a crucial role in mapping out potential risks and rewards. But who or what are these Greeks? They're not ancient philosophers, but rather a set of risk measures that offer valuable insights into the dynamics of options trading. These Greeks are Delta, Gamma, Theta, Vega, and Rho. Each one serves as a compass, guiding traders through the volatile seas of the options market. Understanding these measures is like having a secret decoder ring for the complex world of options trading. They help us anticipate how changes in various factors like the underlying asset price, time decay, or implied volatility might impact an options price. So, are you ready to decode these mysteries? Join us as we unravel each Greek, one by one. First up, we have Delta, the mover and shaker of options. This Greek is all about sensitivity, specifically the sensitivity of an options price to changes in the price of the underlying asset. In simpler terms, Delta is like a crystal ball, giving us a glimpse of how much the options price might move in response to a 1-point move in the underlying stock. Now let's talk numbers. For call options, Delta ranges from 0 to 1. For put options, it ranges from 0 to -1. If you come across a delta of 0.5, for instance, it means the option is expected to move only half as much as the underlying stock. So if the stock jumps by $2, the option price would increase by $1. But what does a higher or lower delta tell us? Well, for call options, a higher delta implies a greater likelihood that the option will end up in the money. It's like betting on a horse that's been winning races consistently. On the other hand, for put options, a lower delta suggests a higher chance of the option expiring in the money. It's like rooting for the underdog who's been quietly improving his game. Let's simplify this with an example. Imagine a call option with a delta of 0.7. If the underlying stock increases by $1, the call option's price would be expected to increase by 70 cents. It's all about proportionate movement, you see. In a nutshell, delta is the measure of an option's price sensitivity to changes in the underlying asset's price. It's like the heartbeat of options, giving us a sense of the pulse of the market. So, whenever you're dealing with options, keep a close watch on delta. It might just be the compass you need in the vast ocean of options trading. So, delta is all about the sensitivity to price changes. Got it? Great, let's move on to gamma. Next on our list is gamma, the speedster of the Greeks. Gamma is all about acceleration and deceleration. It's like the gas pedal in your car. But instead of controlling the speed of your vehicle, gamma controls the rate of change of delta. You see, in the world of options trading, gamma measures how fast an option's delta changes with respect to changes in the price of the underlying asset. So if delta is the sensitivity of an option's price to changes in the price of the underlying asset, gamma is the sensitivity of delta itself to those same changes. It's a rate of a rate, a second-order derivative, if you will. You might wonder, why is gamma important? Well, gamma is at its highest for at-the-money options and decreases as options move further in or out of the money. A high gamma suggests that the delta of an option is more sensitive to price changes. This sensitivity makes the option riskier, but it also opens up opportunities for higher rewards. Let's bring this to life with an example. Imagine an option with a gamma of 0.05. This means for every $1 move in the underlying stock price, the delta of the option may change by 0.05. This change in delta affects the price of the option, and as an options trader, it's crucial to anticipate these changes to manage your risk effectively. So, gamma is not just about the rate of change in delta, it's about understanding the acceleration or deceleration of that change. It's the measure of the curvature of the option's delta. A high gamma can mean a larger move in delta, and therefore a larger move in the option's price for a relatively small move in the underlying stock's price. To sum it up, gamma gives us insights into how delta might change as the underlying stock price changes. It's like having a sneak peek into the future behavior of delta, which can be an invaluable tool for managing risk and maximizing rewards in options trading. So, gamma is about the rate of change in delta. With me so far? Excellent. Let's delve into theta. Now let's talk about theta, the timekeeper of options. As we delve into the world of options trading, Theta is one Greek we can't ignore. Theta measures the sensitivity of an options price to the passage of time. It's like sand slipping through your fingers, a constant reminder that time waits for no one, not even options traders. Let's break it down. Theta, often referred to as the time decay of an option, is always negative. Why, you ask? Well, think about it. As each day passes by, there is less time for the option to make a profitable move. The option's value thus naturally diminishes. This is why Theta is always negative. It reflects this daily decrease in the option's price. Now, here's a useful tidbit. At-the-money options have higher Theta than in-the-money or out-of-the-money options. This means that options with a strike price close to the current market price of the underlying asset are more sensitive to time decay. They lose value faster as expiration approaches compared to options that are deeply in or out of the money. To put it in perspective, let's consider an example. If an option has a Theta of negative 0.03, the option's price is expected to decrease by 3 cents per day, all else being equal. So, if you're an options trader, you need to be aware of Theta. It's like a ticking clock, constantly eating away at the potential value of your option. Understanding Theta can help you make informed decisions about which options to buy or sell and when to do so. It can help you assess the impact of time decay on your options, allowing you to strategize effectively. So, next time you look at an option, remember the timekeeper, Theta. It's a silent player in the game of options trading, but its influence is potent. It's a constant reminder of the fleeting nature of time and its impact on the value of options. Remember, Theta is all about time decay. Still with us? Good, let's explore Vega. Next, we venture into the realm of Vega, the volatility virtuoso. Vega is that Greek who loves to dance with volatility. It measures the sensitivity of an option's price to changes in implied volatility. In other words, it gives us a sense of how much the option's price is expected to change for a 1% change in implied volatility. Now, Vega has a flair for the dramatic. Higher Vega implies greater sensitivity to changes in volatility. This means that if Vega is high, the option's price can swing more dramatically with each shift in volatility. It's like a high-stakes game of seesaw. Options with longer time to expiration typically have higher Vega. This makes sense because more time allows for more potential volatility. And remember, Vega is not just about measuring volatility. It's about understanding how changes in market expectations of future volatility can impact option prices. Let's look at an example. Say, you have an option with a Vega of 0.04. If implied volatility increases by 1%, the option's price may increase by 4 cents. This might not sound like much, but remember, in the world of options trading, these pennies can quickly add up. So Vega is about changes in volatility. Are you ready for the last Greek? Let's talk about Rho. Finally, we round up our Greek journey with Rho, the interest rate whiz. Rho is the risk measure that gauges the sensitivity of an option's price to changes in interest rates. With Rho, we're looking at how much the option's price is expected to change for a 1% change in interest rates. You might have noticed in your trading adventures that Rho is generally less impactful compared to other Greeks, particularly for short-term options. However, don't be fooled by this seeming insignificance. For long-term options, Rho can pack quite a punch. Let's take call options, for instance. If interest rates climb, this could lead to higher option prices. On the flip side, with put options, a rise in interest rates could mean lower option prices. It's all about the intricate dance between rates and options pricing. Now let's illustrate with an example. Suppose an option has a Rho of 0.02. This means if interest rates were to increase by 1%, the option's price may increase by 2 cents. Seems small, right? But remember, in the world of options trading, every cent counts. Remember, Rho is about the impact of interest rates. And that wraps up our tour of the Greeks in options trading. We hope you're now better equipped to measure risk and navigate the options market. Understanding each Greek in options trading is akin to mastering an intricate art. Traders who can decode Delta, manage Gamma, navigate Theta, adapt to Vega, and grasp Rho hold the keys to a nuanced and successful trading journey. These are not mere theoretical concepts. They are powerful tools that, when properly understood and applied, can provide a multifaceted view of options positions and market dynamics. Aspiring options traders should embrace continuous education, stay informed about market trends, and practice a dynamic approach. The Greeks are not static. They fluctuate with market conditions and the characteristics of the individual option. Therefore, the art of reading and understanding each Greek goes beyond isolated analysis. It involves recognizing their interplay and adjusting strategies based on a thorough understanding of these dynamics. Remember, the Greeks provide a multifaceted view of options positions, and their interpretation requires a combination of theoretical knowledge and practical experience. By integrating these insights, traders can navigate the complexities of options trading with confidence, making informed decisions that align with their risk tolerance, market outlook, and financial goals. And with that, we conclude our journey through the Greeks. We hope this guide has been enlightening and has provided you with the tools to embark on your own options trading adventure. In conclusion, understanding each Greek in options trading is akin to mastering an intricate art. Traders who can decode Delta, manage Gamma, navigate Theta, adapt to Vega, and grasp Rho hold the keys to a nuanced and successful trading journey. Aspiring options traders should embrace continuous education, stay informed about market trends, and practice a dynamic approach. The Greeks provide a multifaceted view of options positions, and their interpretation requires a combination of theoretical knowledge and practical experience. The art of reading and understanding each Greek goes beyond isolated analysis. It involves recognizing their interplay and adjusting strategies based on a thorough understanding of market conditions. By integrating these insights, traders can navigate the complexities of options trading with confidence, making informed decisions that align with their risk tolerance, market outlook, and financial goals.